Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Alphabet looking to tap the debt markets with $15 billion in US high grade and a super rare 100-year sterling-denominated note. We have the details.
Plus, Bitcoin slips back below $70,000 after a roller coaster ride at the end of last week. We'll discuss where it can go from here.
And Apple set to debut a slew of new products in the coming weeks, including a new iPhone 17e and updated iPads and Macs.
But first, we check in on these markets that bounce back for a second day. What a Friday close for the Nasdaq 100, and we build on that 2.5% higher with another 0.6% rebound as we really try to digest where the risks are in the tech markets. And of course, as we look ahead to some of that jobs data later in the week. I'm looking at crypto, though. Roller coaster if you were trading it this weekend. We're back below 70,000, having eclipsed it for a moment on the weekend trading edge. We'll dig into that a little bit later, but you're looking at the equity side of the equation and debt.
Yeah, Alphabet, but actually I'm going to do something a little unusual and go to the corporate debt and bond market. Really interesting. Alphabet looking to raise $15 billion from a US high-grade dollar bond sale. Bloomberg reporting that, citing sources, but also going to the banks for a mandate, maybe to look at Swiss franc denominated, and then a super rare 100-year note, sterling denominated, British pound. We haven't seen a 100-year note since like dot-com era, late 90s. But the bigger picture is pretty clear, right, Caro, that we've seen big tech companies use debt markets to fund what's happening in capital expenditures. A lot more to discuss.
And a lot more bond sales probably to be digesting. Let's do it all with Robert Schiffman from Bloomberg Intelligence. We knew they had to finance the extraordinary amounts of AI capital expenditure. Is there enough demand to support these mega bond sales?
Yeah, I think, listen, let's start from the beginning. Do they actually need any money? My answer is no. I think they're borrowing money because they can, because it's super cheap, and that there's a concept that demand for not just AI, but bonds are so insatiable that they can go out and do a 100-year maturity. So yeah, there's tons of demand. If Oracle is able to build a $130 billion book, yes, Google can build whatever book it wants.
This is why going back to basics is probably a good place to start. I agree with you. People would say, well, why is debt a good idea? You know, they look at some of the Mag 7 names and the cash on their balance sheet and say, you know, why is that a useful mechanism for them?
Yeah, well, this is what they taught me in math camp. The weighted average cost of debt capital for all these names, whether it's Meta, Alphabet, Microsoft, Apple, Amazon, is effectively zero. Why do you have AA and AAA balance sheets if you're not going to use them? I think this is extraordinarily visionary. These companies have been prepping for years for greater investment opportunities, and now they finally see it. I think it's just such a bullish sign for this market. And from, again, the bondholder perspective, this is not equity holders being wary about multiples. Bondholders, I don't think, are going to be able to get enough, and they're going to be able to do it along every single part of the curve. And like you said, this isn't just going to be dollars. They're going to the Swiss franc market, the pound market. I wouldn't be shocked if they went back to the euro market or even to issue yen. I think there's going to be demand all over the globe for high-quality Mount Rushmore-style credits like this.
I want to go to whatever math camp you were going to, where you were talking about Swiss yen, sterling-denominated corporate debt. But look, the demand's there. We've seen in other parts of the AI sector, Infineon in Europe tapping the market. It's a chip maker. We've seen IBM come to the market. There's $400 billion that could get done in corporate bonds, just the investment grade sector alone, JP Morgan forecast for this year. How do you think steady it will be for the year? Or do you think we're going to be front-loading this? Are we awaiting Amazon to come straight out the gates, given you've just put out a note about their really strong fundamentals? Yeah,
listen, I think this is the tip of the iceberg. I actually think Bloomberg News is underestimating how much hyperscaler spending is going to be this year. They put out a number of $650 billion just for this year alone.
But that's just the four, right?
I think it's going to be closer to $750 when you include names like Oracle and CoreWeave. And if you think about cumulatively how much spending has gone up, in the beginning of last last year, we estimated 2025 to 2020 through 2030, we're going to see $2 trillion of cumulative spending. We brought that number to $3 trillion in the middle of the year, and now we're up above $4 trillion. So these numbers are astronomical. What do you do on the back end of that? You're going to see a lot of bond deals. Why not borrow when your cost of capital is so low? So I think you're going to see Amazon, you're going to see Microsoft, and even though Apple is not in this hyperscaler game, you're going to see them come back as well.
Robert Schiffman on the corporate credit watch, Math Camp. Bloomberg Intelligence CV, love it. Another mover today is Oracle shares. We're on a bit of a tear. This comes after a tear, up 9%. This comes after D.A. Davidson released a note saying improvements from OpenAI would lift the shares of public companies in the ChatGPT maker's orbit, particularly Oracle. Let's bring in D.A. Davidson Managing Director Gil Luria. We're just showing the kind of top line of your research, and clearly, there's some read-through, right, in the move we've seen in Oracle this morning. Why is Oracle such a key beneficiary if OpenAI is basically able to monetize better, offer more products, and particularly strengthen its enterprise business?
Yeah, most of Oracle's backlog is OpenAI. So they're building up their whole infrastructure now for OpenAI. And the reason the stock has performed so poorly over the last few months is that there was a concern that OpenAI wouldn't be able to pay for it. And now things have changed. We got to a point last week where the market decided that Google was the only winner in AI. And you can see that by the relative performance of Google versus the OpenAI complex, which is Microsoft, NVIDIA, Oracle, and CoreWeave. And it got to be the pendulum swung too far. What's happened is OpenAI has now become more focused on ChatGPT. It's going to start monetizing more through ads. Within the next couple of weeks, it's going to introduce a much better model that will become state of the art again, will overtake Google's Gemini. And importantly, because it now looks like Google is going to win, that created a panic at Microsoft, Amazon, and NVIDIA, who are now going to invest $100 billion in OpenAI so they can keep a counterbalance to Google. So with that investment, OpenAI is going to have $140 billion of cash. They'll be able to pay Microsoft, and then they'll have money to pay Oracle, which again has the biggest exposure to OpenAI. That's why we're upgrading today.
Okay, I appreciate that math on what's changed about the situation with OpenAI being good for it. That's been a question for a long time. You just heard Bloomberg Intelligence's Robert Schiffman, right? Oracle has been at the heart of this question on debt versus payoff. They've had a lot of demand when they've gone to the market, but we are worried, right? They've swung to negative free cash flow. They are taking on a lot of burden. You seem sanguine about that.
It's still risky. To be clear, Oracle really painted themselves in a corner when they took on this much business from OpenAI. And there were two risks. One is, would Oracle be able to get the capital to start the build out? And the second risk was, would OpenAI have the capital and the wherewithal to pay Oracle for those services? It now looks like Oracle will be successful in the fundraise. It'll stretch them, but it looks like they'll be successful. And now it looks like OpenAI will also be successful in their own fundraise, so they'll be able to pay for it. So those two risks that we've had up until really a couple of weeks ago, really, are now look like they're going to go away, and Oracle will be able to build the facilities, and OpenAI will be able to pay for them.
Who else benefits in this scenario? Because I'm seeing notes out today saying, actually, they don't like NVIDIA. They don't like AMD. I'm talking about Lynx Equities, for example, because they are worried that OpenAI isn't going to be there with a better update, with enough conviction to be able to be purchasing the chips that go inside the Oracle data center, Gil.
Well, so now it looks like OpenAI will remain in the race for at least the foreseeable future. And the two biggest beneficiaries by far are Microsoft and NVIDIA. Right? Oracle is a marginal play on OpenAI because of how much of it is of their exposure. But really, if you look at the stock performance of Google versus NVIDIA and Microsoft, that diversion over the last few months is a result of the market deciding Google's won and OpenAI's lost. That is not the case. The race is still on, which means that OpenAI will spend the $250 billion on Microsoft, which now has by far the biggest backlog in AI compute. And then Microsoft, Amazon, Google, and others will turn around and spend that on NVIDIA chips. And so we have NVIDIA and Microsoft with the best business they've ever had. For Microsoft, maybe in 25 years, for NVIDIA, forever. They're both trading in the low 20s on earnings, which are historically low multiples. So it's a historic opportunity in NVIDIA and Microsoft precisely because OpenAI will stay in the race.
What's interesting, Gil, is though that we've heard a lot about the potential of OpenAI having their own chips. Why not more of a Broadcom win? Why do they even stick with NVIDIA here?
Everybody still needs NVIDIA. All this AI compute will overwhelmingly be built on NVIDIA chips. There will be some other chips because all these customers of NVIDIA want desperately to diversify, but they can't do it right now because they're building out their capacity so quickly. NVIDIA has the best chip, has the capacity, it works, it's available. Everybody else will start their own chips, but the only company that really has made any significant progress on their own chips is Google. And that's because they started 10 years ago. That's how long it takes to have a good chip. Ask Amazon. They're 5 years in and their chip is just starting to get good.
Didn't look too bad on the earnings.
Microsoft, Meta, and OpenAI can start building their own chips, but they're very far away from those being any significant portion of their compute. It's going to be overwhelmingly NVIDIA.
Gil Luria, it's always great to have you on the show. B.A. Davison, thanks for bringing us the latest on your research. Meanwhile, coming up, we're going to discuss Bitcoin's slump, its future in the macroeconomic environment with Jalak Putra from Future Perfect Ventures. That's next. This is Bloomberg Tech. Bitcoin, well, it slipped back below 70,000, as you can see on the day, following a pretty roller coaster ride at the end of last week. A slump from a peak of $126,000 in October last year, remember, which comes in spite of crypto-friendly White House, surging institutional adoption. Let's just set the scene with Bloomberg's cross-asset reporter Isabel Lee. Often on the weekend, there's thinner liquidity, so we see bigger moves, and it seemed to be to the upside.
It could be to the upside, but to the downside as well. But now we saw Bitcoin kind of steadying, which is great because it's now hovering around 69,000, which is a big sigh of relief. Last week, it dipped below as much as $60,000. And that 16% decline was a lot because there's a gauge of implied volatility index. It jumped to 97%, which is the highest since the Sam Bankman-Fried FTX days in 2022. But beyond the price movement, I think it's really just about a reckoning. What is Bitcoin? Is it a hedge against inflation, a hedge against centralized government, a hedge against the dollar? And I feel like a lot of people are feeling confused.
Isabel, what's the flows data, the most recent flows data telling us?
We are seeing some inflows, at least with US Bitcoin ETFs. They recorded an inflow of 221 million on February 6th. So you could think of that as maybe optimism again, or maybe just dip buying. But then still, it's really kind of, at least to the people I talk to, they're like, what is this? It's a structural change. It's a philosophical change. I want to dip more into the structural because we know that Bitcoin is kind of being institutionalized. And this may in itself be the problem because on October 10, fondly known as 10/10, that's when we saw billions of dollars liquidated because of leverage and derivative trades. And last week, we also saw the same, $2.5 billion in forced liquidations, according to CoinGlass. So maybe Bitcoin is also kind of possibly becoming a victim of its own success.
Bloomberg's Isabel Lee, terrific reporting. Thank you very much. Let's keep the discussion going with Jalak Putra, founder and managing partner of Future Perfect Ventures, early stage VC firm focused on cryptocurrency and blockchain technology. Something identified in the Bloomberg story that Isabel was just discussing is that all of this has been happening in an environment where we have an administration and policymakers who are perceived to be more supportive of the underlying technology and the industry than prior administrations. Why would this movement and this market action happen, therefore, in that environment?
Well, Isabel pointed to the maturation of Bitcoin. And while we have a very friendly administration, a lot of that was priced into that run-up that we saw to the 126,000. And we're really seeing Bitcoin act more like a risk asset these days, rather than that digital gold narrative that we saw in the earlier days of Bitcoin. And I'd also point to, there's a market structure bill, previously known as the Clarity Act, that is still under consideration in the Senate. So that has not moved as quickly as those of us in the industry had hoped. And I think that's causing a little uncertainty around what the guardrails around Bitcoin and other crypto assets are going to be.
The words that Isabel Lee just outlined are ringing in my head. What is this? Is this structural or is this philosophical? That is one of the great sound bites. Good job, Isabel. But it is a question that comes up a lot. Maybe we should phone David Sachs and ask him, to your point about the progress of this bill. But again, you mentioned the structural part. What is the philosophical part Isabel was alluding to?
Well, the philosophical part, and I've been invested in the sector since 2013, is in the early days, you had a lot of long-term holders, people who believed in the self-sovereign currency, the self-sovereign asset that was not controlled by any government, and was particularly useful to those people in hyperinflationary environments. So that's where that digital gold narrative came, where it was be a hedge. And what we've seen now, and as Isabel said, it could be a victim of its own success. I don't quite say it's a victim quite yet, but we're seeing more institutional holding. And so the institutions have determined that this will be more of a risk asset. It will trade more in tune with assets like the tech stocks, not commodities. And so that's where that philosophical divide has happened. It's great that we have more institutions. We have more acceptance of the sector of Bitcoin as an asset class, but it may not hold as that digital gold narrative, or it may hold as that narrative in emerging markets and not in developed markets.
Jalak, does that matter to your investments? Were you building on Bitcoin as the OG and as rails to future infrastructure? Are you broader thinking, actually, we don't need Bitcoin in and of itself to remain a buy and hold asset? I'm more interested in the underlying technology, to use an overused phrase. I'm more interested in the stable coin side of the equation.
Right. When I first saw Bitcoin, I was really interested in it as a self-sovereign currency, having been raised in emerging markets. However, I was even more excited by blockchain technology. So this concept of having data or assets on chain that could create more efficiency in the trading of data. So if we're going to step away and look at AI, and we look at AI agents, and for them to communicate and transact with each other, it's much more efficient if they can do it in an on-chain environment. Now, that's much further in the future. We're starting to see tokenized securities. We're starting to see real-world assets, so private credit going on-chain. We're seeing money market funds go on-chain. And we're going to continue to see already regulated assets moving on-chain. ICE from the New York Stock Exchange has talked about their initiatives around tokenized equities. So that's all happening regardless of what happens to the Bitcoin price. So we're really seeing the financial infrastructure being rebuilt by blockchain technology, which also powers Bitcoin. I don't think either is going away. I think we just have to separate the two. And of note, stable coins, which are run on chain, those were regulated by the Genius Act, which passed last year. And then we've seen a proliferation of activity in that sector because of that regulation.
Do you continue to call yourself a crypto first VC briefly, or do you become an AI VC?
Well, our thesis has always been around the intersection of blockchain, crypto assets, and AI forming the basis of the next internet. And we've seen the development of these different areas at different times. I think they're all very important to our future. I think that crypto side may take a bit longer to really, form or validate itself in that narrative.
Jalak Jobanputra of Future Perfect Ventures, we appreciate it. Thank you. Now coming up, Apple prepares for an update to its iPhone, its iPads, its Macs. More on that next. This is Bloomberg Tech.
Apple is set to debut a slew of new products in the coming weeks, including a new iPhone 17e and updated iPads and Macs. Here with a breakdown, Bloomberg's Apple and consumer tech editor, Mark Gurman. The Power On drops Sunday, and you basically give us the product release roadmap for the early part of this year. What do we need to know?
Yeah, so there's a new iPhone coming pretty imminently in the next few weeks. It's the iPhone 17e. It's a successor to the 16e that launched about a year ago last year. This new version is going to have the same chip as the iPhone 17, so moving from the A18 to the A19. And it addresses one of the quirks of the first model, which was the lack of MagSafe, which means no magnetic wireless charging within Apple's MagSafe ecosystem. So that's coming as well. Also an updated in-house modem and updated in-house wireless chip to match the iPhone Air from September. You're also going to see some new iPads in the next month or so. That includes a new version of the iPad Air with the M4 chip, so a bit of a faster processor there, matching the iPad Pro SKU from 2024. And then you're also going to see a new entry-level iPad moving to the A18 chip. Now, why is that significant? It'll be the first iPad from the entry-level batch to support Apple Intelligence. And you're also going to see new high-end MacBook Pros and MacBook Airs in the coming month as well. So a lot to like if you're into new low-end iPhones, iPads, as well as MacBooks.
So who's into it, Mark? On that note, I can see a lower price point being attractive, but it's interesting that you are pushing forward the view that enterprises might well be interested.
Yeah, two tentpoles this year for Apple, education and enterprise. Apple is, I would say, tripling down on moving units into both of those segments. They have a lot of the consumers already. They're trying to break into other areas that they've struggled to break into in the past. And all of these products have price points and feature sets that are going to be heavily applicable to business use cases and bulk purchases. Also a low-cost MacBook with an iPhone chip coming as well. This will be sub $800, so this is going to be pretty fancy and compelling for both those segments as well.
Mark, I'm running a 2019-2020 Mac Air with an M1 chip. Just on the Mac part, like why would I want to update? Right, time to upgrade. You have 30 seconds. Why?
Well, because your laptop is 7 years old. Time to get a new one. But no, in reality is that the chips have the chips have gotten much more advanced. They have AI capabilities now. Better graphics processor. So if you're on an M1 machine or an Intel machine, definitely think about getting something new. I'm on an M1 myself, and I'm looking forward to the touchscreen MacBook Pro overhaul coming in the fall. So that'll be pretty nifty as well.
Get on it, Ed. Bloomberg's Mark Gurman. So great to have you on. Thank you very much indeed. Now coming up, investors look beyond the AI data center play. Apparently, Carol Schleif of BMO Private Wealth joins us to see how she's looking past them. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. I'm zeroed in on the chip sector. In the session so far, the Philadelphia Semiconductor Index, or SOX, has swung from a decline of about 1% at the open to a gain of now 1.6%. Really, it's Nvidia as the biggest points gainer that's pushing higher. And there was a lot over the weekend about how confident Nvidia is right now in the infrastructure build-out. One of the laggards, though, is Micron, down 2.5%. There was a report over the weekend, we'll bring you the details later in the show, that Samsung, its rival in high bandwidth memory, is going to start shipping latest gen to Nvidia this month. Our own colleagues at Bloomberg Intelligence have weighed in this morning saying that actually what's going on with Micron and high bandwidth latest generation 4 is kind of muted, but right now that seems to be a story in the market. And again, bring you those deets a little bit later in the program, Karen.
Yeah, you're looking at the hardware. Let's go more broad and look at software and all parts of big tech, the movers they're in. Bloomberg TV markets correspondent Nora Malinda is with us. Nora, take us away, because it was a volatile volatile previous week. How's this week started?
Last week was quite the week. I mean, we're looking at this week, we're seeing the NASDAQ 100 rebounding for a second day in a row. We're also seeing a lot of those software stocks rebounding. I'm taking a look at AppLovin. We've got Palantir in focus, Microsoft. As I'm speaking to my sources, we're hearing that people are really trying to buy the dip. They're really trying to figure out where the risks are in this market and figure out where to best position themselves now. So we are seeing AppLovin in particular. We did see that Citi did mention that their e-commerce clients are up about 3% from the prior week. So that, of course, is also buoying the shares in particular. But we really are seeing these stocks trying to map out, chart a turnaround story here, as a lot of people are trying to figure out which stocks maybe perhaps have the least exposure to some of these risks that we've really been seeing laid out last week. And people are really seeing Microsoft, for instance, if we think about them as a potential bellwether in this space, it really shows that this rally isn't necessarily just exclusive to software stocks, but really just a broad-based rebound for all of tech.
Nora, Melinda, with the markets wrap, Microsoft up 3%. I don't know, I'm kind of think that the anxiety that I was so zeroed in on at the end of last week faded with the Super Bowl. The technology story is broadening, expanding past just AI and data centers. In a recent note, Carol Schleif, chief market strategist at BMO Private Wealth, writes that the real focus is shifting to who's using the technology and how it's being applied. She adds that rising M&A activity, IPOs, and ongoing innovation could help fuel continued interest and momentum in the year ahead. Carol joins us now. I want to start with the shift part, and we'll get to IPOs because, of course, it's been a big story for us here on the show. What is it that you're seeing in a shift? You're seeing the psychology of the market shift, you're seeing the attention of the market shift, or you're seeing people's understanding shift? Which is it?
I think it's a piece of all of those things because it's a natural evolution. You know, when we first hear an innovation, take it back to when ChatGPT was first announced a couple years ago, and then the DeepSeek as well. Investors figure out what's my shorthand way to play this, but it's really more impactful from that and getting investors, particularly our longer-term oriented clients, focused on the issue that we're building infrastructure in the United States. It's putting capital investment in, which we haven't done actually in a big macro way in a very long period of time. And it's teeing up all of these really important evolutions. And you've got a lot of recent examples, for example, in the healthcare industry, where you've had Lilly and NVIDIA announce a joint venture. You had Mayo Clinic and NVIDIA announce a joint venture in terms of processing that data and how science will be done and how diagnostic imaging will be done. And those use cases are getting investors to focus more on those. But it's tough from an investor standpoint because they want to, what can I buy today that's going to be higher by the end of the week?
Carol, you heard Bloomberg's Nora Melinda kind of outline the events of the last 5 days. You know, Friday, we always say one session a market does not make, but clearly there are some deep-rooted concerns that corners of the technology industry, i.e. kind of like legacy software, are at severe risk here. Does your research reflect that as well?
I think the issue is it's also important to remember from a use case scenario, it's not like big corporations or even medium-sized corporations can ditch the software they had. People aren't going to give up their client service processing or their routines. It takes a while to get that stuff iterated in. And I heard one of our analysts this morning just talking about it's not like someone sitting at the kitchen table is going to replace a lot of that macro software that we've been using. But a repricing of do you discount the kinds of growth rates they've seen for 30 years or is it 5 or 10 years? That's partly what the markets are trying to deal with too, is figuring out how does this go forward. Yes. And similar to the first internet build out in 95 to 2000, you have that iteration where everyone's trying to figure out how to use it. And it's those companies, those managements, those industries that can lean into the fact that there's a lot of change. How are we going to participate in it versus sit back and let it be done to them?
Do your clients want to sit back and let it be done to them, or do they want a bit dip by?
I think they're trying to figure out how to participate in it. And we've been warning for some period of time that you needed to see a broadening in the markets because hanging everything on 6 or 7 stocks is not healthy in the long run. And we had talked about and given them a heads up that some of that transition may be volatile. Doesn't mean that people have to sell the 7 and go buy the 493. It can mean the 7 broaden out or flatten out, if you will, and the others catch up, do some catch up. So we've been warning clients about that volatility. Yeah. And our clients tend to be pretty sanguine, if you will, about that in terms of letting us do repositioning as prices are up. And, investing is one of those activities where it's more comfortable to run with the crowd, which is typically the wrong situation to have from a long-term standpoint.
And what we always do is get sucked into just talking about equities a lot, because therein lies the price point. But the bond market's exciting as well. We've got huge amount on deck when you think about Alphabet tapping. We had Oracle last week. We've got plenty more, I'm sure, to come. Is that an area that you're seeing more diversification coming, more interesting corporate debt as well?
Well, I think there is the interesting corporate debt, but it's also important to remember that technology in general has prided themselves on how under-levered they've been. So coming up to using some of that cash flow or balancing off and reserving some cash flow and accessing the debt market and its higher quality debt. So there's that piece of it too. But there's a lot of different ways to play this, and not just the focus on technology itself, but who's making the best use cases of it and who has the most potential. You're seeing small and mid-cap stocks really play too, because they don't get all locked up in having to approve new software per se. They really can lean into leapfrogging some of the advances that they have access to now.
Carol Schleif, keeping us diversified. We appreciate it. BMO, Private Wealth. Now, coming up, tech dominates the Super Bowl ad space. Did you notice? AI was definitely in focus. That discussion next. This is Bloomberg Tech. An Australian AI startup backed by NVIDIA just secured a $10 billion loan from a group that includes Blackstone-led funds to boost its data center rollout. Now, it's one of the country's largest private credit financings. Called Firmus Technologies, the startup plans to construct data centers with a combined capacity of up to 1.6 gigawatts across Australia by 2028, Ed.
Okay, to the private markets. Anthropic is finalizing the details of a funding round of more than $20 billion, which would nearly double its valuation to $350 billion. Let's get the details. Bloomberg's venture capital reporter, Natasha Mascarenhas, here in SF. This is something we broke just before the weekend, chased over the weekend, and we think it's coming this week, right? Where are they at?
Yeah, exactly a month ago, Anthropic came out of the gate targeting around $10 billion. Now we're seeing that amount could go even higher than $20 billion. And this is not just a funding round that's going to include money from NVIDIA and Microsoft, although they are expecting to put up to $15 billion into the company. This is a round where traditional investors are actually putting in new money into the deal as well. We're thinking Menlo, Lightspeed, Altimeter, Sequoia. It runs the gamut.
It's interesting that you didn't mention there the typical crossover funds as well, Natasha, and we are all bracing for Anthropic and indeed key rival OpenAI to be tapping the public market at some point this year.
Exactly. It's actually a fascinating example of how investors are thinking about a company, two companies really, to your point, and investing in them before that initial public debut. So this time we're also seeing Anthropic line up investors for an employee tender, which will give employees a chance to liquidate some of their equity holdings and again, cash out before a future public offering.
Natasha Mascarenhas, it's going to be a busy week for you. We so appreciate you starting it with us. Meanwhile, it was busy with this year's Super Bowl ads, leaned heavily into AI, of course, with tech companies using the big stage to showcase their latest tools and ideas. Now, according to analytics firm EDO, AI.com led the pack in consumer engagement, generating roughly 9.1 times the interaction of a median Super Bowl ad. Joining us now to break it all down is Kevin Krim. He's president and CEO of EDO. What's more bird's eye perspective is that tech dominated just the ad spend, the ad that were out there.
It was the tech Super Bowl, Caroline. It was absolutely groundbreaking to see more AI product ads than there were combined automotive and beer ads, the stalwarts of your typical Super Bowl.
AI.com gains traction. Why? Because no one understands what it actually is. I mean, we now all peel back the onion and understand it's the guy who made his money in crypto.com has bought this very expensive website and now wanting us to all put our details into it and have an AI agent of the future. But what was the recipe for getting us to convert?
Well, there's this heated rivalry going on between Anthropic and OpenAI, and then suddenly this dark horse, AI.com, that no one had heard of, comes in and is trolling both of them, along with Mark Zuckerberg, mentioning all these folks by name. And what you've got is that perfect formula of introducing something totally new to people, but it's completely on trend. This was the AI Super Bowl, and so it surprised people. It caught people's eye, and they crashed the website. It was down for many minutes after that ad aired, and finally came back online. But what I think you saw just writ large was two things going on in the Super Bowl. And we at EDO, we're measuring the outcomes generated by these ads, and you saw people either engaging with new technology that could change their lives, whether it was AI or healthcare. There was a lot of pharma and diagnostic tests being promoted that all did well. And or you saw people going back to the tried and true nostalgia, heartwarming, celebrity-driven pieces. Those were the things that worked.
What's so interesting about the technology piece of this is what was being advertised, right? So there's a lot on social media about the who's who of tech being in attendance at the Super Bowl or talking up their own ads. There were also some fake ads. But my main point, Kevin, these are like enterprise-facing things, B2B. When you measure the engagement or outcomes, like how can we gauge if these were successful pieces of business at the enterprise level that those companies put in place?
Yeah, so what we're measuring at EDO is we're looking at how many people searched for the brand, went to the brand's website, used the brand's app in the minutes following these ads on TV, and it's highly predictive of, very correlated with changes in market share, changes in sales. Enterprise, it's an interesting way to market. You've got to find needles in haystacks, but this is by far the world's biggest haystack. It's the most engaged audience you can find. You couldn't replicate this kind of audience through targeted digital advertising over a month or many months, even if you spent tens of millions of dollars like it costs to advertise in the Super Bowl. So for those folks with an enterprise message, it's still one of the best ways, most cost-efficient ways, ironically, to reach those kinds of high-end audiences. And the game being, as you mentioned, in the Bay Area, in the home of tech, that much better.
Kevin, AI was big, right? But so was pharma, big pharma. You know, as I sat on my couch watching, that's something that struck me. What's the data behind that, please?
It mattered a lot to the people watching to see Novo Nordisk promoting its Wegovy pill. That was one of our top 20 most engaging ads of the game. A very big performance for a pharmaceutical brand. You also had Hims and Hers with an edgier message late in the game, which was a challenging placement overall, given that the game wasn't that competitive at that point. And yet Hims and Hers performed very well and was also one of our top 20 most performant ads in the game. Obviously, they're both in the news today with Novo Nordisk suing Hims and Hers.
It's a hard one, Kevin, but your EDO is all about TV advertising. How much do we think actually is just driven onto online in these moments? You hear that maybe someone caught an ad and you then go and look at it on YouTube. How are we being distinct about where they've put their money to work?
Right. Well, what we're seeing is that the 21st century consumer lives their lives online. And so whether they're watching traditional TV or streaming television or social video, it triggers these online digital behaviors. That is the customer journey in the 21st century. And so by picking up these signals, you're able to really predict what's going to happen in your business going forward. Now, should marketers be spending more or less in TV or social video or other media? I mean, that is why companies like ours exist, is to help them find that right balance. The right marketers, though, they know that there's moments to get a big audience highly engaged, like the Super Bowl, and then there's moments to go with hyper-targeting, and the right balance typically is what we see does the best.
But they also know probably, and why we see nostalgia, why we see Ben Affleck, why we see, the idea of Gen X and millennial viewers. Is that basically what the Super Bowl is? It's targeting like the 40-year-olds or something?
What it really shows is that boomers, they're out of the sweet spot of economic power. It's Gen Xers and Gen Y, those kind of younger Gen Xers like me, the aging millennials who are right behind me. We're in the sweet spot of economic power, and marketers know that, and so they're talking to us. The nostalgia that was quite effective in this game, it was all about late 80s to early 2000s.
Jurassic Park, all
the Backstreet Boys twice. You had that kind of effect. We had Bon Jovi several times. Green Day kicked off the game. It was targeted at us.
The one thing that a lot of people struggle to understand is with some of the bigger ads from some of the bigger technology companies, a lot of them were released in advance of the Super Bowl, right? They're posted wherever they're posted. What's the strategy behind that?
There's a lot of debate about what the right release strategy is. We find that any one of them can work, but surprises tend to do the best if you're introducing a new product. Teases of a fun idea where you're building on the idea on social, but leading to a real unveil at the Super Bowl, that's also quite effective. Less effective is just put it all out there a week ahead of time and then expect a pop at the Super Bowl. It tends to not work as well that way.
Kevin Krim, CEO of EDO, and a long time ago also, I should say, was global head of digital at Bloomberg. Thank you very much. Now, coming up, Workday's co-founder comes back for the top job at the company, effective immediately. We'll have that surprise news next. This is Bloomberg Tech.
Time now for Talking Tech. First up, Meta is facing a warning from the EU. Now, the social media giant is under scrutiny over policies that restrict the use of rival AI assistants on WhatsApp. Now, the European Commission has issued a statement of objections, cautioning that it may step in to prevent what it described as serious and irreparable harm to the market. Now, Bloomberg's Francine Lacroix sat down with the European Commission Executive VP, Teresa Ribera. Take a listen.
I don't know how it may be read by any government, but my sense is that this is not connected to politics, but connected to well-functioning markets and the protection of consumers.
Plus, former Apple design chief Johnny Ive has unveiled a car co-designed with Ferrari called the Ferrari Luce. It features tactile switches, physical controls, aluminium details in the steering wheel and air vents. Now, the design is deliberately moving away from a screen-heavy aesthetic, embracing what Ive describes as a more physical world approach. And ByteDance, well, it's turning heads with its latest AI video model. The TikTok parent just rolled out C-Dance 2.0, and the quality of the clips has surprised both analysts and industry watchers. Now, the launch has generated plenty of buzz and helped lift shares across China's media and AI app space. Ed.
Okay, some news. Workday co-founder and current executive chair Anil Basri is returning as CEO. He's replacing Carl Eschenbach with the change effective immediately. The news comes just days after Workday announced it's cutting about 400 jobs. Who's across it? Bloomberg's Brody Ford. It's the Monday after the Super Bowl. The phone rings 5 a.m. The editor's saying, Brody, get to your desk, Workday. Yeah. What do we need to know? I mean, this is a stock that's reacted negatively to the news, but has been on a slide for some months now.
You need to know it's a really tough time to be an application software company, right? I mean, whether you're Salesforce or Adobe or Workday, you can put up pretty good numbers. You can say that a lot of people are using your AI tools, but right now, Wall Street is just not going to believe you. And that's what's been happening with Workday. I mean, they're down 40% over the last year before this event today, and it seemed they said, we need to show and we need to make a step toward a more product-focused company. Maybe the last guy who we thought was going to lead us to a new era was seen as too salesy. We need somebody who's really going to focus on that AI R&D.
And so is it right to go back to the co-founder, Brody? How does the market interpret that?
I think no matter who they picked right now, the market wouldn't have loved it. Right now, I think if you do anything that's not exceptionally and unambiguously positive, the market wants to sell application software stocks. Right, I mean, the founder, he's a familiar face. I have seen some questions around if you want to lead a company into a new AI era, do you want to go back to the same person? There's arguments both ways, but clearly investors are not stoked.
The stock trading at its lowest level since November 2022. Quite rightly, I'm going to ask you, what is Workday and what does it do?
Right. Well, when you look up your benefits for, healthcare or vision, you're probably logging into a Workday system, no matter what company you work for. So their core application is for human resource management, but of course, like everybody else, they want to expand into agents and other parts of the software stack.
And we also know who's expanding into agents and the enterprise area. Brody Ford, thank you so much.
Thank you.
That does it from this edition of Bloomberg Tech. We've got a big week ahead. There's yet more earnings thick and fast, but the bond sales, they're going to come too, and we did it all today.
Yeah, like big tech has looked to debt to fund capex, and as Robert Schiffman outlined and recap it on the podcast, it was a good conversation. That's okay. It's a good way of managing capital for them. Do recap the podcast. You know where to find it. It's on the Bloomberg terminal. It's online. It's on Apple, Spotify, and iHeart. From San Francisco and from New York, this is Bloomberg Tech.